If you've ever watched one of those reality TV home renovation shows and thought to yourself, you know what, I could absolutely do that, well, you are definitely in the right place. But today we're moving far beyond the dramatic music, the fresh coats of paint, and the stylish staging. In this explainer, we're going to look at the hard data, the hidden financing secrets, and a strategic pivot that literally changes the real estate game completely. We're going to transform the reality of house flipping into a data-driven roadmap for building actual long-term wealth.
Okay, so take a look at this concept of a house sitting on stacked coins. It perfectly captures our ultimate goal in real estate, making your capital work smarter, not harder. In this industry, cash is simply a tool, and how you choose to leverage that tool determines whether you're just creating a temporary, highly demanding job for yourself, or if you're actually building a true, self-sustaining financial empire. It is the core difference between trading your time for a one-off paycheck and establishing a portfolio that generates passive income while you sleep.
Here is our roadmap for today. Number 1, the house flipping reality. 2, financing your flip. 3, the rental market boom. 4, the BRRRR Method. And finally 5, running the numbers.
Let's dive right into Section 1, the house flipping reality, where we'll uncover the actual data behind those TV shows. Now, what's really interesting here is this staggering number. 407,417 homes were flipped in 2022 alone. That marks an 8.4% share of all home sales, which is a massive 58% jump from just 2 years prior in 2020. This frenzy definitely wasn't an accident. The pandemic housing boom, combined with those historically low interest rates at the time, created this perfect storm for investors to find distressed properties, rehab them, and capitalize on sky-high buyer demand. It just proves this market is incredibly active. Investors are out there putting in the real work. But as any seasoned investor will tell you, finding and fixing the house is only half the battle. The real challenge? Figuring out exactly how to pay for it.
That brings us perfectly to Section 2, financing your flip. Let's look at how to actually secure the money you need.
So there are 5 main financing paths used by the pros: cash, home equity and HELOCs, hard money loans, private lenders, and owner financing. Listen, your financing choice is just as critical as the property itself. Traditional banks and credit unions often get a bit jittery about the risks of fix and flips because, well, they prefer 30-year commitments over short-term bridge loans. Because of that, investors usually have to turn to these alternative paths. And the fine print in these options dictates your ultimate return on investment, meaning a wrong choice right here can easily ruin what would otherwise be a highly profitable flip. Let's compare a couple of these. Using cash is great because it skips the lending line entirely. You've got no underwriting delays, no origination fees, and absolutely zero interest payments. Plus, you can buy properties in literally any condition. But there's a huge catch. It eats up your reserves and severely limits your ability to diversify. If you tie all your liquidity up in one single house, you completely miss out on other lucrative deals that might cross your desk. On the other hand, HELOCs, or home equity lines of credit, cleverly leverage your existing home's equity. You only pull out what you need, which makes it super affordable and flexible. However, if property values in your area take a sudden nosedive, you could find yourself underwater and your borrowing power is completely capped by the equity you've personally built up.
Now, when we contrast hard money with private lenders, it really comes down to speed versus terms. Hard money loans are asset-based. The lender cares way more about the property's potential after repair value than they do about your personal credit history. This means quick approvals, sometimes in mere days, which is absolutely essential when you're competing for hot properties. But that speed definitely comes at a premium, featuring high interest rates and requiring pretty substantial down payments. Private lenders, meanwhile, are usually just individuals looking for a solid return on their personal capital. They offer easier qualification and highly tailored terms that you can negotiate directly. But keep in mind, they still carry higher rates than a conventional bank and come with their own unique legal ramifications if a project happens to go sideways.
Moving right along to Section 3, the rental market boom. Let's talk about why holding beats folding. Picture this: you found the house, you financed the rehab, the drywall is up, and it looks beautiful. Now, what do you actually do with it? What if the absolute best way to maximize profit on your flip is to not sell it at all? What if instead of handing over the keys to a buyer for a quick payout, you hold on to them and put up a for rent sign in the front yard? This is known as a buy and hold strategy, and right now, broader macroeconomic conditions are practically screaming for investors to heavily consider taking this route. Get this, between the second quarter of 2020 and the second quarter of 2023, we saw a jaw-dropping 29% spike in home prices. This rapid asset appreciation is doing something really profound to the overall housing market. It is aggressively pricing first-time home buyers out. When you combine these highly inflated home values with climbing mortgage interest rates, the hurdle for a standard 20% down payment becomes entirely insurmountable for millions of families. But those folks still need a place to live, right? And that fundamental need drives them directly and continuously into the rental market.
And it's not just basic economics at play here. It's a major cultural shift. Nearly a quarter of millennials, 24.7% to be exact, now plan to always rent. That is nearly double the rate from just 2018. They are prioritizing flexibility and mobility over being tied down to a 30-year mortgage. As a result, single-family rental occupancy rates have consistently stayed above 95% for years. This demographic data completely justifies our strategic shift toward becoming a buy-and-hold landlord. By keeping the property, you get passive monthly cash flow from super reliable tenants, incredible tax benefits through depreciation, and long-term asset appreciation as the property's value continues to climb.
Welcome to Section 4, the BRRRR Method. This is the ultimate recipe for scaling wealth.
Enter the BRRRR Method. It stands for Buy, Rehab, Rent, Refinance, and Repeat. It's an investment strategy that serves as the absolute perfect bridge between the quick, active income of traditional house flipping and the passive, long-term wealth generated by renting. Historically, the biggest barrier to building a rental portfolio was simply running out of capital. You save up, you buy one rental, and then you have to wait years to save up another down payment. Well, the BRRRR strategy completely circumvents that roadblock. It allows you to build a massive amount of equity and scale a portfolio rapidly without constantly draining your own cash reserves. So this method breaks down into a straightforward 5-step wealth-building flywheel. First, you buy a distressed property under market value. Second, you rehab it, fixing it up to create immediate forced appreciation. Third, you rent it out to a qualified tenant, which secures your passive monthly income. Fourth, and honestly, this is where the absolute magic happens, you execute a cash-out refinance. Because you significantly increase the home's value during the rehab phase, a bank will issue a new loan based on that higher appraised value. This allows you to pull your original capital right back out of the property entirely tax-free. Finally, step 5, repeat. You take that extracted cash and use it to fund your next property, repeating the whole cycle endlessly. Finally, Section 5, running the numbers. Let's let the math do the talking. Okay, imagine a hypothetical property that you've bought and rehabbed for a total initial investment of $147,000. In scenario 1, you treat it like a standard flip and sell it immediately. After paying short-term capital gains taxes, realtor commissions, and closing costs, you walk away with a net profit of $15,678. That is an 11% profit margin in 1 year. Hey, it's not a bad payday at all. But compare that to scenario 2, the rent and hold path. You finish the rehab, execute your cash-out refinance to get your money back, and you rent the home for 5 years. After those 5 years, assuming a very conservative 3% yearly appreciation, you finally decide to sell. Your total net profit, combining 5 years of rental cash flow with the proceeds of the final sale, skyrockets to an incredible $54,985. Your profit margin balloons to 37%.
When you look at it visually, the difference between those two outcomes is absolutely undeniable. We are talking about a nearly $40,000 gap in total net profit on the exact same property. Yes, scenario 1 gets you cash in hand much faster, satisfying that immediate desire for a payday. But by exercising just a little bit of patience, holding the property, and letting your tenants consistently pay down your mortgage principal while the underlying asset appreciates, you are literally multiplying your returns. It perfectly illustrates the sheer power of delayed gratification and strategic leverage in real estate.
But before you run out and start building your massive rental empire, consider this final thought. Managing properties takes real, sometimes exhausting effort. If you hire a professional property management company to handle tenant placement, turnover, and ongoing maintenance for those 5 years, it's going to cost you roughly $8,500 out of that amazing $54,000 profit. It undeniably drops your final margin slightly. But here is the critical question you need to ask yourself as an investor. Is sacrificing a fraction of your profit margin worth having a professional handle those 2 a.m. plumbing emergencies? For many, buying back their time and protecting their peace of mind is the ultimate definition of true wealth.